Hey everybody, today I will be walking you through my single-family residential investment model. This model is completely free. I built it for those who are interested in buying, fixing, and selling homes, or buying homes specifically as rental properties, either of those two strategies. And the reason I built it, I don't personally invest in single-family homes. Nonetheless, I know a lot of you do, and I just haven't found a lot of great residential investment models online. I know there are a few, but they cost money, and so I thought, hey, I'll build a free one for those of you who are interested. Now, this is a fully dynamic model where inputs are placed or put into the assumptions and the construction budget tab. Those inputs flow through calculation modules, most of which are built into the cash flow tab, and then outputted in the pro forma and summary tab in the form of return metrics, amount of cash needed to execute on the investment, etc. And I'll walk you through each one of these as we go through this tutorial. So let's get started. The first thing you're going to want to do is you're going to want to download this model. In the upper right of this screen, there's a little, I believe it's like an eye icon that you can click and download the model. You can also find the link to the model in the comments of this video. Once you've downloaded the model, you've opened it up. Start here at the Instructions tab, and the Instruction tab will walk you through what you need to do. I'll do the same thing right now. So the first thing you're going to do, you've identified a home that you want to buy. You believe it's worth buying, and now it's a matter of let's put all of the variables that are specific to this property into the model, and we'll find out what type of return, see if this is worth doing. So to do that, we will start with the Assumptions tab. You'll click here on this blue tab at the bottom. We will then start with property name. Now keep in mind, in this model, any cell with blue font is a cell that you can input. Please do not change any other cell. If you change any other cell, it will change the calculations and could potentially break the model for you. And so this has been built in a way where you change blue cells, all other cells then change based on the inputs that you put into those blue fonted cells. So we start here with property name. We're going to call this Winston Court. This is our address. This is our city. Then there are two strategy types. Under strategy, we have a little drop-down menu. Also note that if you mouse over any cell, a little box is going to pop up. It's going to give you instructions on the box. You'll also notice on most of the tabs, I have a little tan box off to the right. That tan box also provides you instructions specific to that tab. But here we mouse over this strategy, and it tells us, look, this model allows us to do two strategies, either a flip strategy, where you buy the property, you fix it up, and then you immediately sell it at that point in time. Or we have a hold strategy. A hold strategy, we're going to buy it, possibly we're going to renovate it, we may or may not renovate it, and then we're going to hold it as a rental property for some period of time, and then at the end of that period of time, we're going to sell the property. So in this box, we're going to choose, using this drop-down menu, which strategy we want to use. Now, if we choose flip, the hold period, the period in which it's rented, is going to be blacked out. And that makes sense, right? Because in a flip scenario, right, there's no hold. You fix it and then you sell it. In our case here for this tutorial, we're going to be using a hold strategy. Next, what I like to do, you may be wanting to print this report out for a potential investor partner. You might want to have a printout for your own business plan, whatever it may be. It's nice to have a property picture in the model. So you're going to click in this cell here. You're going to come up to your insert ribbon. You're going to select pictures. You're going to find the picture on your computer. Going to double click, and it's going to pop in here. Now the picture is not going to be the same size as our box, but you'll notice inside the box it tells us the dimensions of this box. And so to make this picture that dimension, we're going to come up here into the upper right corner. We're going to select the size. We're going to detail this out. We're going to remove lock aspect ratio, change the height to 1.87, the width to 2.75, and close that, and there we have it. We've got our picture in there. Now our input, our assumptions, and the information on the property looks great. Next, we're going to talk about timing. Timing is specific to certain milestones that happen in your investment. Your very first milestone being you've got to purchase, right? So in this case, we assume that we are going to close on this home January 1st, 2016. Next, there's going to be a renovation period. This could be anywhere from 0, so you're not planning on renovating it, to 12 months. The model does not allow you to have a renovation period longer than 12 months. In this case, I'm going to put 2 months. Next, we have the hold period. Because we're going to be using this investment as a rental, the rental is the hold period, and it starts from the day you finish the renovation until the end of whatever you identified to being the hold period. So here we're going to place our hold period as 30 months. Then you have a months to market. Now this is the number of months that you believe it's going to take to sell the property from the day that you list until the day that it closes. So let's say in your market it takes 120 days on average to sell your type of property. We're just going to go ahead and put 4 months in there, or 120 days, and we get a black cell. Now, a black fonted cell. This is a cell you should not change, and this tells you that based on your previous 3 inputs, your investment period, the length of your investment, is 36 months. We also have another outputted cell, again, not an input, so don't change the cell. This tells you the estimated sales date based on your purchase date and the total of your investment period. So we think that we're going to buy this January 1st, and our plan is to hold this and close December 31st of 2018. Next, we're going to look at our construction budget. Now, you'll notice that this construction budget cell is also a black font. It's an output. Well, it's an output from the construction budget tab. So what you're going to do at this step is you're going to come down here to your construction budget tab, and you're going to create your inputs for your construction budget. Now you have 2 options here on the construction budget. The first option is, let's imagine you just bought this, or I'm sorry, you just noticed this property, you went by it, you like it, you don't know specifically itemized what the cost of the renovation is going to be, and so you have a basic idea. You think it's going to be about $20,000. Well, you come up here in this yellow cell, and you put $20,000 in. Then you come back to the assumptions, and you'll notice that the $20,000 has populated here. But let's also imagine a different scenario where you now you're a little bit down the road, and you'd like to build out a more itemized construction budget. Well, you set this cell to 0, and that opens up now your itemized list. Then you're going to come in here, and you're going to put your general requirements. This is whoever your contractor is, contractor ABC. This is the estimated cost for the general requirements of that contract. You got your site prep through Excavators Limited, right? So you're going to come through and you're going to identify the contractor, or maybe you're the contractor, but whatever it may be, you'll identify that individual or company. You'll identify the cost. The sum of all those costs provides you an estimated cost, and now it's an itemized budget. So rather than using kind of this back of the envelope, just real quick and dirty estimate, you're going to now itemize it somewhat, and we get to this 26,500 number. Now we come back to the assumptions tab, and sure enough, there under construction budget, there it shows us 26,500. Once we've finished our construction budget, we're going to input what we estimate the property tax per month to be. Now, oftentimes this amount is included in your mortgage payment. Nonetheless, it's important that you include it right here. Also, your property insurance, what you estimate that to be per month. Then we're going to look at acquisition price, or the purchase price. What do you think you can buy this home for? So let's imagine this pretty home at 555 Winston Court is on the market for $200,000. Well, based on guidance from the broker, and I think I can probably get this home for $190,000. So we drop $190,000 in there. Then there's a question: what are our closing costs going to be on the purchase of this home? So those may include your loan origination fee or points that you pay to the lender, appraisal if you're in a market where the buyer pays the appraisal, recording fees, transfer taxes, title and escrow fees. There's a host of fees. What fees you pay is largely dependent on the market that you're in. For this case here, I'm going to assume 1.5% is what my closing costs are going to be on the purchase of this home. And then finally we have due diligence costs. And this isn't a percentage of purchase price here, like closing costs were. This is a dollar amount. And so these are things like I'm going to send someone out to inspect the property, and that's going to cost me $500. I might have to do an environmental study, depending on the type of home that I'm buying. Maybe there's some attorney's fees that are not included in my closing costs. Maybe there's some title research that's not included. Maybe I'm going to hire a consultant to help me with this or that. So we have some due diligence cost involved in this prior to closing. In this case, let's call it $1,500. The next question we're going to ask ourselves is, at the end of this 36-month investment period, what do I think I can sell this home for? Now that I've remodeled the home, I've brought it up to market standards, and after 3 years have passed, and I think that values in my area are going to grow by 5% per year, for instance, what do I think the sales price of this home is going to be at that end of that period? And here, I'm looking into a crystal ball. I don't know, but I'm going to put $275. And then I have brokerage commissions. More than likely, I'm going to hire a broker. He's going to charge me 4, 5, 6, 7%. In this case, I'm going to put 6%. And then I have other closing costs. Again, there might be appraisal fees, title recording fees, closing escrow fees. There's a host of fees that might be included in the closing of this when I sell at the end of my investment period. In this case, I'm going to call it 1%. Next, I'm going to think about what is it going to cost to finance this? More than likely, I'm not going to buy this all in cash. I'm going to go to a lender. She's going to tell me I can lend you 90% of the value of your purchase at 5% interest rate on a 30-year term. And so based on that guidance from my lender, 90% LTV or loan to value, that's a loan amount of $171,000. Again, notice it's a black font, so don't change the cell. It automatically calculates for you. And then let's say that she told me 4 3/4 is my rate, and I choose to do a 30-year mortgage. This then is my monthly payment. And lastly, because this is a rental, I have some rental assumptions. So the first question, how much can I rent this home for? Once I've renovated it, it looks great. I'm in a market where rentals are popular. I'm going to rent this thing out at $1,900 a month. I believe I'm renting this where tenants paying utilities, but maybe I have I have sewer and water fees. I have maybe some general maintenance and repairs that I have to do every month. Possibly I have maybe lawn care that I agree to pay. So there's some sort of operating expense per month that goes along with renting this property. And so keep in mind, operating expense per month does not include, so do not include in this number whatever your property management fees might be. So if you use a property management company, do not include that in operating expense. That's in a separate assumption. Don't include your mortgage payments. Specifically principal and interest, which that is this number here. So don't include that here. Do not include property tax and do not include property insurance because we already include that here. So what you will include here, though, are things, like I said, maintenance and repairs, utilities, other expenses that you are going to be paying every month for having this. I'm going to call this here $250. Actually, no, let's call it 200 is fine what we had. Then there's a property management fee. Look, I don't want to deal with collecting rent. I don't want to deal with getting the thing rented up. I'm busy with work and all the rest. I didn't buy rental properties so that I can be fixing toilets all day. So I'm going to hire a property management company, and they're going to charge me, in this case, 6% to manage my property. And that's 6% of my annual gross rental fees. Okay. Next, there's a days vacant per year. When we underwrite commercial deals, this is typically a percentage. I ask days vacant because I think it's an easier question for you to ask yourself. If you rent this thing for 365 days a year, how many of those days do you think this home is going to be vacant? Now, 20 days is about 5 to 6%, which is a pretty good rule of thumb for a multifamily or for a residential rental. And so I'm going to put 20 days. But perhaps you're in a market where vacancy rates are a little bit higher and you want to put 30, 40, 50 days, 60 days, whatever it may be. That number then is going to be a negative in your cash flow, and it's going to plan for things like vacancy. It also might include things like your tenant doesn't pay you rent one month, you have to kick them out, and you've got 45 days worth of vacancy in a year. That's where that's coming in. And then it automatically calculates for you what that vacancy percentage is, which flows through to the cash flow tab, and you'll see that in a minute. And lastly, capital reserve. What kills a lot of less sophisticated investors, a lot who are investing in single-family rentals, is that they don't set aside money every month for future capital expenditures. At some point in time, you're going to have to change the roof. At some point in time, you're going to have to change the HVAC system. You might have tenants that trash the apartment, and perhaps the deposit doesn't cover the carpet and the paint and whatever you have to do. So you're going to want to set aside a certain percentage of your gross income every month to cover those future capital expenditures. We're going to call that a capital reserve. In this case, it's going to be 5% of our monthly rental income. So that's it. You've put all your inputs in, and now let the model do the rest for you. Now I'm going to walk through how the model works, but really at this point in time, you're done. You can jump over to the Performa tab, you can jump over to the Summary tab, you can check out, based on these parameters, what your investment would do. But to go through how this works, now that we have the assumptions in the Assumptions tab, we have also the assumptions in the Construction Budget tab, we go to the Cash Flow. And here in the Cash Flow tab, this is where all of the work is getting done. And everything from the acquisition through the operations, your expenses, down to a net operating income number, on a monthly basis, down through capital reserve, renovation. Now you got a net cash flow before debt. Then you layer in your financing with your loan proceeds that come in from loan balance, your debt service or your monthly mortgage, your principal and interest payment. That gives you then a net cash flow after debt. Drops down then to our disposition or our sale at the end of our investment period. And we have a sales price, less broker commission, less other closing costs, less our loan payoff, gives us then a net proceeds from sale. And last, we have this unlevered cash flow number, which is what is our net cash flow before we layer in our financing. And that gives us then some return metrics, which I'll describe when we get over to our output, our Performa, and Summary tabs. We have unlevered equity multiple, our internal rate of return, what our equity requirement, or how much cash we're going to have to come up with if we don't get debt to execute on this investment, etc. And the same with levered returns. Levered returns being these are our cash flows after layering in that financing that we had assumed in our assumption tab with the returns involved. Okay, so from here we flow over to the Performa tab. Now the Performa tab is a summary of what we just saw in the cash flow tab. And so typically when you're looking at properties, you're not going to need to go to the cash flow tab. You spend 5 minutes, you drop your assumptions into the assumptions and the construction management tabs, and then you jump over here to the Performa tab, and you can see what's happening based on those inputs that you included. So to walk you through it again, you have your purchase price, your closing costs of the purchase, the loan proceeds that come from the loan you're taking out, and this is the amount of cash that you're going to need to come in at closing with. Then we have in the first year our effective gross revenue, which is essentially the total potential rent revenue that we have in this property, less any vacancy that we had assumed. That gives us this number. You'll notice that year 1 is less than year 2 and 3 because the first 2 months of this year we were renovating the property. It wasn't available for rent. We subtract out our total operating expenses for each year, and that gives us this net operating income number. After that, we subtract out our capital reserve, and it appears like the 5% that we put is not sufficient, really. And so, this is something we should probably go back and look. We're going to want at least a couple $1,000s every year in capital reserve. And so that's why, this Performa tab is great. It helps you see how realistic maybe some of your assumptions are. After subtracting out the renovation, we get this net cash flow before debt. So before making our loan payment in that year, this is the amount of net cash flow that we have. Then we subtract out our loan payments. Loan payments were about $900 a month, and so this is the annual total. And that gives us this net cash flow after debt in each year. Of course, year one's going to be negative because we spent a lot of money in renovation. We reserved for future capital expenditures, and the revenue we had from rental that year wasn't enough to overcome the other expenses that we had. And then, of course, in year 2 and 3, we do have a positive net cash flow after debt. At the end of year 3, we sell. And so we bring in the gross sales price, we subtract out our sales closing costs, we pay off the loan. This is the payoff for the loan on the day of the closing, and this gives us now a net proceeds from the sale. We add that to our net cash flow after debt, and this is our net levered cash flow for our investment. And the returns for this are our stabilized cash on cash. Now, if you're not familiar with a cash on cash return, so you take stabilized, meaning you take the first year when you get 12 months of real rental income, and you divide that by the total amount of cash or equity that you have into this investment. And that gives you this stabilized cash on cash number. This is especially important for investors who care about cash flow. So I want to know, if I put $1,000 investment in it, what percentage of that $1,000 do I make every year? And so in this case, you would make $89 every year because of that 8.9% cash on cash return. Then we have equity required. This is the total amount of equity that you're going to need to come up with in order to make this investment happen. Now you'll notice our net levered cash flow is negative 48 for the first year. So you might ask, why isn't it the same? Well, that's because this 52,000 comes from the monthly number. This is 48 because there was some rental income that was realized, and that subtracted your net total for the first year. Nonetheless, you had to come up with $52,000 in equity prior to your first dollar of income coming in. Next, we see your net equity at disposition. That then tells us what our net equity gain is. So net equity gain, think of it this way. You invested $52,134 in this house. At the end of the day, there was over $106,000 in cash that came out of it. Well, we'd invested $52,000. That means we realized a gain of $54,000 in cash. Therefore, our equity multiple, okay, the multiple by which our equity grew, is 2.04. And our levered IRR, our levered internal rate of return, or our internal rate of return with financing, is nearly 30%. If you're not familiar with internal rate of returns, look it up. I'm not going to get into a finance lesson here. Nonetheless, this is an important metric, especially as you get better and you're looking at more diverse investments. Important understanding what type of returns do I get on this investment versus others. Once we finish with the pro forma, and this is really a great place to come and just a quick look, is this investment worth doing? Maybe there's some tweaks that I need to make to assumptions. We're going to make a tweak right now. We're going to come up here and we're going to juice up this capital reserve to 10%. And there we have this, and I think that's probably a little closer to where we want to be. Our returns obviously are diminished some because of that. And then we jump over to our summary. This summary is a lot of the same information that we have on other tabs. This is a great sheet to print off and include maybe as a cover to your business plan or what have you. It's going to identify kind of the basics of the investment, your acquisition, loan amount, the total amount of cash that you need at closing, the total equity or the total amount of cash you're going to need to make this thing happen. And so if you're out there looking for investor partners to provide some equity, you know this is the amount that you're going to need for this. This here is your net equity gain from investment. So it's a little lower than it was because we juiced up the capital reserve. But this tells us that we have an increase in equity, or the equity multiple, with financing of nearly 2 times. So we know that our cash is almost going to double because of this investment. That gives us this 28.47% IRR, levered IRR, and 11.16 unlevered IRR, and then again our stabilized cash on cash return. So that there is my single family residential investment model. If you have questions, feel free to email or comment, and I look forward to seeing you out there in the real estate world.